Hey everyone, Sean Taggy here, the Chief Operating Officer and partner of Memphis Investment Properties. Today we are so excited for our SOFA Summit to have a special interviewee right now is Scott Trench. Scott, how you doing, man?
I'm doing great. Thanks for having me here, Sean.
Oh, Scott, man, we are so honored to have you here at our 2020 SOFA Summit and to shed some light and knowledge on financial independence, real estate investing, and to help people out as best we can.
Yeah,
Um,
looking forward to it. These are some of my favorite subjects.
Yes, sir. Yeah, you are definitely a master of these subjects. Just so people know, I met Scott at the BiggerPockets conference in Nashville in 2019. And man, Scott, just like within the first few minutes of talking to you, I immediately resonated with just like how great of a leader you are. You're a very smart guy. I mean, man, you blew my socks off in just a few minutes. I knew you knew what you're talking about and can really help people out. So I'm super glad to have you on board and glad we get a chat.
Well, I appreciate the compliment. Thank you. It was very nice to meet you as well. And just sorry we couldn't have it again this year.
Yeah, man, it's a bummer, but we're now chilling on our sofa so we can enjoy it just the same way, and we got some great people here, so that's awesome. All right, guys, just a little background, a bio on Scott Trench. He is the CEO and president of BiggerPockets, and he has dedicated his career to helping the average Joe American build wealth, in part through real estate investing. He also has written a book, Set for Life. We can dig into that a little bit, I'm sure. And also, Scott is the co-host of the BiggerPockets Money podcast, where he helps, yet again, the everyday American achieve and build financial independence and wealth. So, Scott, with all of that, man, let's dive in, kind of to the high level on financial independence and strategies that people can be using in their day-to-day lives to build wealth. What do you have to
Yeah.
say?
Financial independence is kind of my obsession or my career, goal is how many ordinary people can we help become financially free as early in life as possible, right? And look, there's a million ways to get to financial independence, by the way, is the removing of dependence on wage income from your life. So you can still work after you become financially independent, so like I do, but you're no longer dependent on the income from your paycheck in order to maintain your lifestyle, the happy lifestyle that you want. And I believe that that's an incredibly powerful goal for a large number of people, maybe most or all people, it's to reach at some point in their lives, because I think there's happiness, there's meaning, and there's purpose dynamics that begin to change as you approach and then exceed that goal. You're no longer, your boss no longer has power over you in an unhealthy way, and you work largely because you are passionate or want to do something. I think these are the people that are going to go on to change society, have impacts on the world, improve their communities, whatever. We dangle the carrot of, hey, after you achieve financial independence early in life, you're going to go on to drink a lot of margaritas on the beach. And we hope you do that for a couple of months. But we know that if you could do that in your 30s, 40s, or 50s, that you're going to take a quick break and then get right back to work, changing the world for the better. So,
Right. Yeah, it's totally about your why. And what I see so many people too, our audience, like they want to get there so quickly. And like sometimes I just say, hey, just pause. Like if you can just think you're already in that zone or will get to there doing these strategies, it just makes that journey getting there so much better. I definitely have had that thought when I was kind of in this phases of learning real estate and everything. It is like so stressful and you're your boss and you're stuck in the cubicle. So I definitely have related to that. I was working that kind of type of career, climbing the ladder, and yeah, it's hard, man.
yeah,
Starting
it's more than numbers on a piece of paper too, because you can get there overnight on paper. You buy $100 million complex and you get a 1% brokerage fee in terms of equity in there. You're technically a millionaire, but you're leveraged 1 to 99 versus the guy who's got four paid off houses, each worth $250,000 with stable long-term tenants. Very different profiles of financial independence, very different outlooks. And I think that it's going to vary per person in every regard. And for me, I'm much more along the lines of like, hey, I really want that more conservative. I want money to be exceptionally boring in my personal financial portfolio so that it's just not an issue for me and I can go out and spend my time worrying about more important things.
right, yeah. So if people are, let's say, our typical audience, someone working a job, making pretty good money, and trying to work up to this financial independence, what are some strategies, like their top 3 to 5 things they could be doing to kind of start building this wealth and working towards the ability to quit their jobs, quote unquote?
Yeah, so there's every single person who wants to move toward financial independence is going to have to do a combination of four things, one or more of a combination of these four things. They're going to have to spend less and accumulate more capital. They're going to have to earn more active income from a job, whatever side, those types of things. They're going to have to invest the proceeds of their income less their expenses in something that is reasonably aggressive or capable of producing financial freedom in a timely manner, or they're going to have to create an asset such as a business or a book or a blog or whatever it is. You have to do one of those four things. And that's the framework I apply to every financial story I come across, and I've come across hundreds of them. And if there's a fifth area that doesn't really fit neatly into one of those buckets, I'd love to hear it. Maybe inherit or marry. Those are different ways. But
Right.
okay, so if you're going to do one of those four things, you have to assess, like, where is my leverage, right? So
Right.
let's talk about a military person, for example. A military person is they have the same four rules. They have to do those four things as everybody else, but they have no ability, or relatively limited ability, to scale their active earned income in the near term, right?
Right.
So trying to go after that, reading lots of sales books, for example, wouldn't be very helpful in that scenario as an investment of time. Instead, they can focus on not spending like sailors, which is, my funny pun
Yes.
for
Good
the
way.
military
Live
guys.
well below your means is always a good way to start.
Exactly. And they have a housing allowances and other types of things that could allow them in a reasonable period to accumulate $20,000-$30,000 a year. Right. And then on the investing front, they have that much to invest, but they're also getting stationed around the country at different markets. Right. Or they might have off days where they can go and think about creating an asset. But really, we find that, hey, like the spending less, keeping really tight budgetary controls, and then that maybe real estate investing approach is a good combination for that person. A
Right.
doctor would be different, right? Because they have a huge amount of earned income.
Mm-hmm.
They just need to not spend crazily, and then they probably want to invest very passively, right? And
Yes.
they're not going to have time to start a business. So it's kind of understanding those four pillars and, like, where's my leverage? Do I have time to commit to
Right.
a more active investing approach, like a real estate or business or business type approach? Or do I have really high income or business potential that I need to focus my time there on, spend reasonably, not, cut every dollar, and then invest more passively in like an index fund or with a partner in real estate who's going to take a chunk of the returns in exchange for whatever it is.
Right. Yeah, I love that so much. Like those four quadrants, and we could micro into every single quadrant. Of course, like the basics of saving more money. I mean, setting up a budget, things like that. Earning more income. How to maybe choosing more education to get a raise. Ways to expand your business or whatever you're doing. Sorry, what were those other three quadrants? Three was where you're investing in.
Mm-hmm.
All that. Why
Spend
don't you
less, earn more, invest, or create.
invest or creative, and then the fourth is creative business or
Yep.
or like a real estate thing. Yeah, that's awesome.
Mm-hmm.
In terms of that third one, I think that's where most of our people are at. They're earning pretty good money. They have some money saved up, and either they're looking for something to invest in other than in their bank account, or maybe something better than the stock market. What are some options for them on their investment approach? Like if you were sitting there, let's say a doctor, and you're making some good income every year, like what would be their options laid out for them that they should consider?
Sure. I mean, I think the obvious options are real estate, stocks, and then debt, right? And as a younger person, I come with this with a bias. I'll turn 30 this year, but I own very little debt because I feel like my equity investments are going to produce much more long-term wealth, more volatile than other types of debt. But those are really the three, I think, buckets that I think make sense for the non-business investor, right? Those are the three most accessible types of asset classes, I think, for these folks. And so when you think through that, look, stock investments, I'm a big fan of index fund investing. And so every month for the last 7 years, my entire career, I invest a significant amount of capital right into a Vanguard index fund. And I set it and forget it and don't look at it. I do it first through retirement accounts. And then when I max out my retirement accounts, I then begin to invest outside of that in after-tax brokerages, right? I invest in no debt, but that will change as I age and need to change my mix as I begin approaching traditional retirement age or my older years, right?
Yeah,
And then on real estate, I think real estate is a perfect sweet spot, and that's what everyone's here wants to talk about.
of course.
For a specific type of individual, I think you have to be above that median income pass line, or at least approaching it. If you're not there, it's going to be very difficult to get the access to financing and ability to accumulate the, modest, I think, 5-figure sum needed to actually go on to transact on properties. There are creative financing methods, but we find on BiggerPockets, for example, that very few of our users earn less than about $45,000 a year, right?
Right.
Because it's just that much harder to break into this asset class without that kind of being at that starting point in the economic journey in America today, unfortunately, right? And then the other side of that, we also see that very few folks who earn significantly over $200,000 a year are active real estate investors, and that's one that's very interesting for me.
Yeah.
Because and what I've kind of thought about this is in order to break into real estate investing, especially if you're going to buy like single family rentals, duplexes, triplexes, quads, those types of things, that's a big mental risk. This is a huge proportion. If you're like me or any one of the other folks that have, invested, I'm sure a lot of people can relate. It's years of savings and discipline to come
Right.
up with the capital needed to make this investment. And we hear these horror stories, 2008, people losing their shirts, all these mistakes that you can make. And so what we find is that not all, but most investors who get going in this business invest a entry price, which is not in dollars, but in time. It's in dozens or hundreds of hours of self-education through, summits like this, podcasts, books, interviews with other investors and agents, right? And I don't know how many, that's probably going to vary for every individual, but I bet you that most of the people here who have intentionally bought their first property put in at least 100 hours, maybe in the order of 300, 400, 500 hours of self-education and work prior to buying that first investment. And that investment is perfectly appropriate for the $50,000 to $200,000 a year income earner. But I speculate that the much higher income earner isn't willing to put in that amount of time
Right.
in
Or
order
don't
to
have.
say,
Yeah.
yeah, because their dollar per hour rate is that much higher, and they can invest passively to achieve a similar overall wealth result in a similar period of time.
Right. Yeah, I love you breaking that down for us and talking about it is worth spending some time due diligence, picking a market and things like that. Let's narrow that down. So of those three approaches, of course I know our people are familiar with the stock market. They can lend, create debt and lend out money later on as they get more towards the passive, safer end in their careers. Most of them though are in the 30 to 50 age range, so they're willing to take on a little risk in real estate for the reward. So now let's kind of dive in on, if you are going to invest some time, 50 to a few hundred hours of time, what would be the most optimized use of that time to kind of, for these people of what they should be researching about real estate investing and all that?
I think the hard answer is you have to become comfortable with real estate as an approach. You have to get above that threshold of I can do this, right? And feel good about it. And that's going to depend on your market, your strategy, where you're learning from, what you're doing, all these different types of things. For me, it was probably just hundreds of hours of listening to podcasts. I contributed on the BiggerPockets forums for a long period of time. I probably read 10 or 15 books prior to making my first investment, and I met with local investors. Some milestones that might be helpful are when you're kind of very clear on what you want, or you can talk to local investors and you're like, okay, these 10 people all have 5 properties, but 2 of them are really sharp.
Right.
5 or 6 of them seem to be kind of just average, and 2 of them are extraordinarily dumb and are going to get screwed.
Right.
Maybe that's too harsh of a statement, but like if you can
Right.
begin picking that out amongst those cohorts, that's probably when you're rounding out the level of, hey, I'm getting pretty comfortable with this and know how to do it. You're never going to have a model for every decision, every type of property and every type of conceivable problem, but you can get enough to feel like, hey, I can handle what's thrown at me at this point, given the experience that I've absorbed from my self-education and
Right.
interactions I've had.
Yeah, and I agree. I think that's what a lot of our people do before they come to us. They're like, hey, I've checked out a few markets, so they've done their market research. I've checked out some providers, and they've zoned in on what questions to ask the property manager. I've read a few books, Rich Dad Poor Dad, perhaps, listen to some BiggerPockets podcasts or other things like that. And so that is totally advice. But then, like you mentioned kind of towards the end, some get so wrapped up and so scared and fearful, but it's like, enough to make those informed decisions. And if you pick whether it's turnkey investing or trying to invest on your own or buy your own rental in your own market, you just kind of need those basic barriers, and that's all you need to really get started. Because other than that, it's experience, and I see so many people getting stuck there. But I'm glad you're kind of reassuring that, is you got to check it out like that. So Scott, how can people pick a market? Let's say they don't want to invest where they're at. What would be the best ways for them to kind of go about picking a market? And let's say they do want to invest in a cash flow market because they're looking for, some good cash flow to replace their income someday.
Yeah, so I think if you decide, hey, I don't want to invest locally and I want to invest in a cash flow market, right? The first thing you want to do is you want to determine what that cash flow actually is. And again, I think I mentioned it earlier, but cash flow, the way to estimate cash flow, in my opinion, is to take your gross rents less your average vacancy in your market, less your property taxes, less your insurance, less your property management fees, because you're going to have property management fees in particular if you're going to invest out of state, right? And that gives you kind of a maintenance and capex reserve as well, if I didn't state that. So that's going to be what your cash flow is going to produce. So you want to look for a region, like a city, like Memphis, right, like where you guys are, for that cash flow, and say, how does that array versus my other options, right? And if it's close, then that's where I think, maybe you have like 3 options that are pretty close. Maybe that's where you say, hey, I'm going to go with the one where I have the best management connection or people network that is going to give me that extra trust or comfort zone, or maybe the one that I'm going to visit, or whatever it is, as they rate close, unless you have a big outlier, of course. From there, you want to say, like, where is my cash flow and appreciation potential combination in that market the best, right? And that could be a neighborhood or zone. Like, if I know Denver really well, so I know, like, hey, Southwest Denver is really that spot right now where we think we can find the appreciation and cash flow mix. The Northwest of Denver, for example, does not have that cash flow potential because it's already surged in price so much over the last couple of years, without the rents keeping up.
Man,
Just understanding that analysis.
Yes.
Right? And you can.
And I love that so much because, like, if, a lot of people come and they're like, oh, there's so many great markets for cash flow. But then, like you mentioned, they zone in really on the operator. Above that, it's kind of sixes all across the board, the top cash flow markets. And they come to us and just go, hey, we've toured your facility. We see you guys have been in business for lots of years. You have a big staff. You do a lot of deals. You know the market so well. And yeah, so operator is a factor. Of course, appreciation over the years. Memphis has appreciated 4 or 5% over the past 3-4 years, year over year over year. It has great cash flow too, and it's poised to go up. Mm-hmm. But then, like, sometimes people just go, there might be a market that might be a little better, but I love the operator here, and that's why they sometimes pick us, is because they feel comfortable there. And I like that you brought that up. So definitely should be like on your top 5 is market, cash flow, appreciation, but operator and management is a huge deal.
100%. In an ideal world, those are all equal across every market, but we know that we're not in the ideal world where that exists, right? So, if you have a good operator and partner in that market, that's where you can really cheat a little bit and not have to go through that next set of steps I was lining up around picking that neighborhood, then picking that hyper local or block, like in these cities, and every city in the country. The wrong block can make a big difference. It might be on that main road that you don't see on Google Maps if you've ever driven it, right? Or it might be next to, old commercial retail that's no longer attractive or good for the prospects of that community. Those are things that you can't tell if you're not there and don't know that market, and you need somebody on the ground to figure that out for you, or you need to be able to zero that in. So it's regional, like zip code or neighborhood, and then hyper local. Wow. Making those determinations so that you're very clear on what you want. And the end result of that should be, I think, in my opinion, you don't have to write it down. It could be a helpful exercise, but an ability to articulate in great detail what you want. Can I give you an example of that real quick?
Sure, yeah. Paint the picture. What does it look like?
All right, so this is what it was for me. I want a duplex, triplex, or quadplex investment in Denver, Colorado. I'm not concerned. My price range is fairly large, but I'm looking for a certain amount of cash flow to rent to purchase price, right? I'm interested in the southwest quadrant of Denver, along with specific other neighborhoods that are small pockets of town that I've identified, right? I'm looking for a property that is between $175,000 and $225,000 per unit in purchase price that will rent for that $1,500 to $2,000 per unit price range, right?
Love
I'm looking for a 1950s build or later. I like 2-bed, 1-bath, or 1-bed, 1-bath units, or I'll take a unit that has ability to add an extra
it.
bedroom or bathroom very easily because I can add value there. But I like those types of units because they're less difficult to rent in awkward times than the 5-bed, 2-bath
Yeah.
unit that's going to be a little harder to find a tenant for, at least in certain or different economic times, right? I'm looking for that kind of like C to B range, not that A property, because I don't think it's not realistic in at my price point. And I know that 10 properties like this sold in the 90 days leading up to the coronavirus crash in March. So I know that that's a realistic potential as I wait and see what's going on in the next, in normal circumstances, just say the last 90 to 180 days. But in the context of coronavirus, we know that there's some interesting things going on in the market. So it's important to look at that period right before and then following to see if there's been any changes in sales. I do not look at active listings. I look at sales because that is my real comps. Active listings can sometimes be properties that sit or are unrealistically priced in the meantime.
Man, I wish our listeners would go back and just write that buy box for themselves if they're looking to invest in Memphis or any market. That what you just have there is pure genius. You totally are letting the universe know what you're wanting to buy. You're also setting yourself up to not go emotional and get a deal that you're not wanting to buy or anything like that. That was all genius stuff you have down there, Scott. And man, you are very disciplined and thorough in what you're looking for. I love that so much, man. So that's great.
That's the output of your research.
Right.
If you
Yes.
come up with
Based on
that,
your
you're going to
research,
be in
have
good
your
shape.
box, your buy box. It's great. And I've actually played around with your BiggerPockets insights, and it's got all these graphs and tables, and you can kind of, spreadsheet out everything. I think it's really awesome what you guys are doing over there. And yeah, I kind of did the top cash flowing markets, and Memphis, Birmingham, Cleveland, all of them are up there, but it kind of helps you at least zone in whether it's your personal market you're in, and you can kind of compare apples to apples, of their averages of what you're looking for. And I think that would help out a lot of our investors kind of zone in on what they're wanting. So now let's say
I think
though,
it'll be a really interesting exercise, for example, to go and be like, hey, Seattle, right? I just pick that as a West Coast city that's obviously experienced a lot of appreciation, and we don't think of as a cash flow market. I
right,
have to go back and do this, but it'll be interesting to see about if the investor who invested there 5, 6, 7, 3, whatever years ago versus the investor in Indianapolis, who ultimately created more wealth, and was it predictable or not that was going to happen, right? And what are the markets? What are some comparisons we can make over the next 10 years? And I think investors will be in a lot harder of a choice because the cash flow is easy. It's you can not easy, but you can see the numbers and that's what you can operate to. The appreciation is that speculative piece that makes every investor super uncomfortable, but is a very real part of the equation and is priced into these markets and something to consider. So anyways, just a hard, fun problem about real estate and why Wall Street hasn't come in and taken over this market and leaves an opportunity for us.
yes, and it's totally balancing appreciation, cash flow, enough and all that, and just lined up based on your goals and what you're looking for. And so we'll leave the audience at what they're deciding on and use that for their own knowledge and getting started. And kind of mentioning Wall Street, one of their big barriers, I think, is being able to do this at scale. So how does someone, go in and then start managing their property and operating it for excellent cash flow? Let's say, assuming they've already picked a market and a neighborhood and all that.
Yeah, well, let's start with. I think the first and most important reason Wall Street is not in the small residential income property market is because of financing problems, not management. Our competitive advantage as landlords, small landlords, is we can buy single family duplex, triplex, or quadplex properties with fixed rate 30-year Fannie Mae backed mortgages. And we can get up to 10 of them per individual,
Right.
and layer in some more. So 93% of single family rental properties in this country are owned by investors with 10 or fewer units. And just 1 to 2% of those single family rental units are owned by institutional investors like the Invitation Homes or those kinds of big names. They make all the headlines, but they're complete non-factor in the single family space. And I speculate the duplex, triplex, and quadplex markets because of that similar dynamic, although I don't have hard data on that one.
Right.
So the second piece though is obviously management is another big concern there. And again, this comes down to that dynamic that I was talking about earlier, where it's that dollar per hour value of your time. And I think that that applies here as well. Like when I first started out, I was making $48,000 a year as a financial analyst, right? And so the dollar value of my time was about 25 bucks an hour.
Right.
And managing my properties was a very profitable exercise for me at that rate because I had put in the time to learn it, and it was a skill set that command, you know, if my property, you know, rented for 2,300 bucks a month and it took me, you know, I would have had to pay
Yeah.
10% of that, it only took me a couple hours a month to manage. That's a profitable exercise for me, especially since I was house hacking and living at the property,
Yeah.
which saves so much time in commutes and those types of things. But over time, my portfolio has grown as has my income. And so my dollar per hour value of my time has grown. And now I hire a property manager to take care of the business. And I think that's another really powerful factor for landlords. In bad times, I can take back property management if I were to ever need to, right? And resume doing that. And that gives me a huge risk reduction in my overall portfolio versus your Wall Street competitor or big business competitor, right? So a lot of advantages in those types of things for, I think, the small investor. But I think it really comes down to, I think you're right that the property management is a piece, but I give it the,
The
if
leverage is a big
2/3
one
is
too.
the
Yeah.
is that access to financing. I think that's really the prohibiting factor from allowing Goldman to buy up all the property and
Totally. And there's
competition
so
with the
many
small landlord.
there's a lot of and there's so many mom and pops out there selling. Like it's so hard for them to economies of scale buying from each individual owner, buying one or two here where they just need to buy a big package at once. So yeah, lots of ways in that. That's
And every
interesting.
real estate investor who knows their local market, like knows like,
Oh,
oh, the big
have such a
development's
better
going
advantage.
on.
Yeah,
Yeah, they're going up over there. That thing's happening here. The public transit's going there. That guy's probably going to sell in a few years. That neighbor's, a piece of work, but they're moving, whatever it is. And those are things you just can't put in a spreadsheet, right now. And I think you won't be able to for many, many decades or if I'm.
or if not ever. Yeah, totally. I love it, man. Let's dive in a little bit on your personal investing philosophy. You mentioned you're putting your money, directly into an index fund, kind of waiting. I'm assuming you're waiting there for when it builds up to maybe invest into something else. Yeah. So what are you currently doing on your investment approach?
Sure. So I have my money spread out across a number of asset classes. As so first, I have my real estate portfolio. I've house hacked for 7 years, and I've brought in a partner in my real estate as well. And we've built a portfolio together. So I've got 8 doors in that portfolio, all in Denver,
That's
right?
a good market to be in
With
right now. Yeah, that's
yeah,
good.
a certain amount, of leverage. I think we're probably leveraged at 50, probably around 50% of the asset value. So I need to refinance or buy more because that's a little less leverage than I like to have in order to sustain long-term returns. But I'm not feeling too bad about it in the context of coronavirus in 2020.
Correct.
Um, so that's one. Second, I invest in addition to that real estate bucket, I am starting to invest in syndications right now. So I've invested in an apartment complex out in Phoenix, and I'm planning to do a little bit more of that. It's a totally passive exercise. I feel like I know the operators pretty well, and I understand the risk profile of the investment, but there's it's a certain comfort with the being totally passive and
Right.
being having trust in the operator and the overall approach there. Third, I guess moving on from the real estate side of things, actually, in addition to the real estate thing, I invested in crowdfunding, and I did kind of a hard money bridge loan through a crowdfunding portal, which is now defunct, and have learned my lesson. I do not believe I'm going to get much of that money back. I haven't received very much interest on it, and hoping to get a portion of the proceeds that I invested back. But it's a relatively small loser, but certainly a nice loser for me. Um,
Right.
the bulk of my cash that I've put into investing over the years has really been in stocks. So I invest basically in Vanguard, boring index funds, S&P 500 index funds, US based.
Yeah.
And I just put in a sweep. I have a certain amount I want at my personal account, a certain amount I set aside for real estate, and everything above that I just sweep into index funds. At first, I did not invest in retirement accounts because I was saving up for my first house hack. As soon as I bought that house hack, I guess, and stabilized my cash cushion, in the last couple of years now, I've been maximizing my Roth IRA, and I have a Roth 401k through BiggerPockets that I, as an employee, that I contribute to. I'm a really big fan of these Roth accounts because, I'm a skeptic and think that taxes will increase over time.
Yes.
So I'd rather pay taxes now and not pay them later
Right.
than do the 401k that's not the Roth and not pay and defer taxes now and pay them back later. I just, that's my mentality with the retirement accounts. So I invest there. I invest that in index funds, and then I invest in index funds and after-tax brokerage accounts with dollars once I've maxed out those contributions. And then I
That's
also have a large position in BiggerPockets. As CEO, I invest in and am very optimistic about the prospects of this business. And I have a book that I've published, and am writing another one.
Oh, okay, cool. Yeah, we'll dive into that in a little bit. Man, I love it. You're spread out over a lot of things, put in all these other areas. I like that you diversified a lot.
Yeah,
And I thought
and
it's
I know
really
very few real estate investors who are concentrated totally in real estate.
right.
Almost most of the folks I talk to, there's a couple exceptions, but most of the folks really have real estate and these other buckets as well.
Yes, I do too. I'm spread out, not quite as much as you are, but definitely a good way to approach it. I like that you mentioned also you're investing into syndications. We just did one of our own like syndications where we raised some money around $2 million for a 124 unit here in town, and kind of using that as a second approach for people who bought a few doors with us, turnkeys back in the past. We invited them into the fund, and it worked out really well. So yeah, that's another way that we are trying to help out our investors, whether they don't have the time to buy and manage their own property in their own market. They can buy a turnkey from us, or also if they even don't even want to have to manage the manager, us, and a turnkey, they can just invest into a syndication and they get their preferred return and everything like that. So
Yep.
it's kind of cool. Yeah, it's fun to kind of see all those strategies out there. Okay, thank you so much. And also, man, I appreciate you kind of telling us, the good and the bad about all your investment portfolios. I'm sure some learning opportunities for the ones that didn't go good, but also it sounds like you're doing very well on all the others. So that's good to hear, man.
Yeah, it's just I have a investing philosophy and approach, right? I'm going to invest long term, 30 for 30 plus years in assets. I'm going to use appropriate leverage in real estate, be more semi passive about that, be totally passive in index funds, invest for the long term. And then if I'm going to concentrate my resources or invest in something that I have to manage, I'm going to keep my eyes on it very, very closely, which is what I do with BiggerPockets. And
Right.
so it just kind of making sure that you have those philosophies and things written down, thought through, and then you apply them consistently forever. It's simple but not easy, I guess.
Man, I love that you said that. I think that is a great gold nugget that I think a lot of our listeners can apply is so many of them are this 1 year approach, 2 year approach on investing and get so emotionally tied in and like, something goes bad on a property or in their own, stock portfolio and they want to get out of it, and I think you're just like totally non-emotional, you're in it for the long game. I'm in this for 30 years. If things go down or up, I'm just in it for a long time. I like that approach you're having so
Yeah.
much there. That's great, man.
I when people kind of bring that in, they're like either they want to get rich quick, which I can understand,
Right.
or I think more likely they don't have a financial foundation capable of supporting investing before they get into investing. What is a good financial foundation? You're saving hundreds or thousands of dollars per month from your regular job or existing whatever, however you source your income, and that accumulation rate is significantly in excess of what you need to survive. And then you have a large cash position that is capable of giving you the ability to sleep at night, which
Love
varies
it.
for everyone, right? It could be 6 months for somebody, it could be 2 years for somebody else.
Yeah.
There's no wrong number there. It's whatever you need to feel like you don't ever have to touch your investments and you can invest for the long run. Because when you invest for the long run, the short term gains
Yeah.
seem to pile up. And when you invest for the short run, that's when you seem to have all these problems and never get to where you're trying to go in the long run. Like, the stock market is going to dip by 30, 40, 50% once every 7 to 8 years, right?
Right.
Or if not more frequently over the course of the next 50. I know that's the case. Why would I freak out about it when coronavirus hits? Because it's a non-factor. I knew that going in. Every investor should know that going in when they invest in a stock market index fund or a company in the stock market in general that's that's impacted by market forces. And so, look, when you just invest for the long run, these short-term wins, I think, begin to pile up anyways. So,
Right. Man, you brought it up a little bit. I love, first, I love that approach. That is me too. I'm working on that. I still sometimes get all, look at my monthly statements like, oh no, we're going down, we're going up. I try,
yeah,
of
you can't
course.
go
Of
bankrupt.
course, yeah. Of course, like
If you
a
go
day,
bankrupt, then you're ruined. Yeah.
right. I need like a day to let the emotions go away. But then, you got to get back in your bearings and be like, here's my approach. Here's what I'm doing. I know things are going this way or south or north, but just keep sticking that long-term plan. Love it. And you brought up, of course, COVID and all that. Let's dive in briefly on, is now a good time to invest? What's happening with the market and the real estate, especially in real estate? There's a big debate on that. What are your thoughts?
I think that it's perfect that we just had the discussion we just had prior to asking this question, because here's
Totally.
the deal. My goal is to build to a level of comfortable financial freedom in a completely sustainable long-term way. So what does that mean for me? It means every month I'm going to sweep my accounts and put that money into stock market index funds. And I know I'm going to get that 8 to 10% long-term compound annual growth rate. Maybe you call it 6 to 14. People have these arguments about what the stock market is going to produce,
Yes.
whatever it is. But I'm going to get some kind of return in that ballpark over the next 30 years if I leave the money in there and never touch it, right? With real estate, I invest in real estate because I expect that incrementally more, I expect incremental return over and above what I could get in the stock market. If I don't expect that, what am I doing given the long-term nature of my approach? Where I think I'm going to get that 8%. So I have to get that 15, 17% compound IRR, that compound annual growth rate in my real estate if I'm going to be in this game. And in order to get that, I have to use leverage, which I don't know how deep you want to go into the math there, but you have to use some kind of leverage. And I think in order to sustain that in average market conditions, and I have to operate effectively, and I have to know my stuff, which means I'm going to have to self-educate and operate and spend time. And that time has to be worth that extra return. So for me to hit my real estate goals, I've got to buy consistently once every year or two, keep my money invested, keep a sustainable amount of leverage, and operate efficiently. And so it doesn't matter what the economy is like in that context. It doesn't matter what the market conditions are like in that context, because I need to I'm like almost dollar cost averaging through real estate, right? So I know I'm going to hit my long-term goals in order to, and I have to just continue to sustain my approach in order to do those. But I know that's not the question that's on everyone's mind. I know that the question is actually what is going to happen with coronavirus.
Yeah,
so
of course. You have your crystal ball. Tell us. I know, right?
So after kind of explaining why it doesn't really matter, now I'll explain kind of how I'm thinking about the current market. And I'm not an economist, but I like to think through all this stuff. And
Right.
maybe I'm a amateur, or do this for fun, or because I'm interested in thinking about it. I think what's happened here with the coronavirus is that the U.S. government has poured a lot of money into the economy. And some of it, there's a lot of controversy about this, about how it was effective. I don't want to get into the politics. There's a stimulus and all this other stuff. But a real, in my opinion, part of this stimulus package is the expanded unemployment package, right? And so you're finding that people, the folks that largely lost their jobs, are getting a 9-month unemployment package with greatly expanded benefits for the most part. Right. And so we have not seen significant increases in rent defaults. We have not seen increases in evictions. We have not seen these numbers. They make the headlines, but they're not there. It's not real. Like, there was a headline for the Wall Street Journal when this all came out that was like, nearly a third of tenants didn't pay rent by this date. Well, in most months, tenants basically pay only a little bit more than that. And they were comparing a month that had the 5th business day of the month was a Sunday, when you can't cash rent,
Right.
to a month in the prior year where the 5th business day was a business day, right? When that month settled out, there's no way that the defaults are anywhere near the ballpark of what folks are talking about right now.
Right.
So what's going on?
And I like can't stress that either. Like, in our local market, I don't know the total economy in Memphis. I mean, we're only having like a 1 to 2% dip in the year over the past 3 years of what our average collections have been every month. And I mean, we are actually at an all-time low in inventory for rental properties, and then also, of course, in properties for sale. So I mean, we're not seeing it quite as much. And yeah, like you mentioned, we're helping our tenants get their PPP, get the government checks and their stipends and all that and the unemployment. And I mean, it's working out. So I understand. I want to rant on just locally. We're kind of seeing that same thing in all these biases, but really it's working out pretty well. Right.
100%. And everybody knows somebody who's gotten hurt by this, right? So I'm not saying that there's no pain,
Yes.
but I'm saying that there's a huge portion of the population that I believe is having almost no overall reduction in their income or ability to spend. Right. Or if there is, maybe there's a reduction in spending that's a natural consequence of the quarantine and the social distancing that's been going on, and the much more greater work remote flexibility options for many employees. Or if they're not working, it's very similar levels of income. And so what's happening here is we're not going to see, in my opinion, a increase in problems next month, the month after, whatever. If we're gonna see a problem, it's gonna be 9 months from that March, April crash that we all experienced. That's when the unemployment benefits run out and when the government's going to have to make the next set of steps. And like, who is betting on that? Who knows what's going to happen? I think odds are government's going to do something, but I don't have a crystal ball and can't figure that out. I do know that if the government does then inject more money into the economy, expand unemployment benefits, those types of things, that is a cost to society in order to benefit landlords. And what I mean by that is they're going to have to raise taxes, and landlords do not realize income tax for the most part, right, on wage earners, or they're going to have to spur inflation. And landlords benefit from inflation because we're leveraged against
Yes.
an asset that will nominally increase in price, and then rents will go up against our fixed debt leverage. So I don't know if there's a lot of good answers for, I speak to the policy ramifications of that, what you will. This is me libertarian bent going, but I think the best thing the government could do is do nothing. And landlords would then have to negotiate with tenants for lower rents and those types of things. But if we subsidize unemployment tenants so that they can continue paying rent, I think you're accreting value to landlords at the expense of the rest of society, which is a whole different issue. But yeah.
Interesting takes, man. I appreciate your thoughts and opinions there, and I think that's some interesting stuff to look into. Love it, man. So lastly,
so the answer is now could be a very, very good time to invest in real estate,
right,
or it could be a very, very bad time to invest in real estate, or it could be a neutral time to invest in real estate.
or just
I think it's a bad time to hold cash.
Buy a property every year, and you can't go wrong there either. And it's just every year you're buying the good and the bad, and just do it. I love, like, yet again, to your long-term approach.
Yeah, for me, I'm going to do that. Yeah.
Yes. So, man, we've kind of coming to a conclusion on our time here. Why don't you tell our audience a little bit more about where people can find out more about you? So what kind of things do you have going on, and how can they hear more about what your thoughts are and things?
Sure. You can find me at the BiggerPockets Money Show podcast. We host it every week. It's a podcast on building a financial foundation capable of supporting regular investments like those in real estate or stock market, or building a business, working toward financial independence. You can find us at BiggerPockets.com, which is obviously a big resource for real estate investors who are looking to kind of put in those hours of self-education, listen to podcasts, read books, join the community, meet people, those types of things, so that you can kind of get comfortable with the first or next steps in your investment approach. And then you can check out, you can ping me at scott@biggerpockets.com if you have questions. I clean out my inbox every business day, and love hearing from folks who have questions, challenges, concerns, anything like that.
Cool. And also your book, Set for Life. And then, wait, you mentioned another book you're writing. Can you give us any insight on that one, or is that still in the under wraps?
Yeah. So this book is about buying your first home, which we think is a really big
step.
decision for middle class America that really has a lot of long-term investing implications. So, for example, if you buy the biggest, nicest home that you can possibly qualify for, that's probably going to use up a large amount of your liquidity position and a huge chunk of your disposable income. And the more you can have that first house in particular be a home that could be a rental one day after you leave, right? That you could flip, for example, if you needed to while you're living there. or the lower cost that home is overall, the more disposable income you're going to have to invest in other types of things, and just understand that cost and weighing that against there. And what we also recognize that you want to love your home and live there. So it's kind of for that couple thinking about buying their first home and wanting to have discussions about just how
Right.
far to go on the price point and the optionality downstream.
I think that's so good, and I love because I'm speaking of looking for a house for myself, a second one, but my first one was a duplex house hack, and it set me up so well in terms I learned all these things. It was a low risk because I needed to live somewhere. I built some equity in it, learned it, from BiggerPockets and house hacking. And yeah, I see so many of my friends, mid 30s, 30s, mid 30s, just maybe their first house or their second, just way above, maxed out their DTI, and they're just stressed. They're like,
Yeah.
we can't go out to that restaurant because we got our mortgage, we're tight. I can't go do this fun thing, and then also we can't invest. So like almost like not only like traps you monetarily, but I think even your mentality, you're stuck on just I need to stay here, I need to stay safe in my job. All these things.
That's
Anyways,
right.
I see your
I think
point
it's
there. I think that'd be
I think it's a
very
trap.
yes, such a the matrix, and you're stuck in the trap, right? Of you have to stay in your job to fit your debt to income to make those mortgage payments and everything else. Anyways, I won't rant off too long on that. And man, I think the same thing applies to investing your first investment property. Whether that's one locally in your market that you're looking to kind of flip to rent or burr, or like I mentioned, if you don't have time, picking maybe turnkey is something for you, or out of state burr. All those options, and each one has its pros and cons, if you're looking to it. So, I mean, and it sets you up, your first investment sets you up as well for the long run. So I love it,
And I
man.
think there's a
That's,
whole
go ahead.
yeah. I was gonna say I think there's a whole spectrum there where you just described. You can go from that burr where you're gonna manage a rehab, then operate it. And that's gonna be very time intensive, but potentially produce a very high return, all the way down to like a syndication investment or even a REIT, which is
Right.
totally passive, which is going to produce a different. I would expect. Look, if I was going to invest in your syndication, for example, I'd expect less of a return than from a bird deal. Otherwise, I'm
Totally.
investing in your syndication deal all
Right.
day long because it's totally passive. Why would I do more work for less return? So you
Right.
have to kind of think through those different things and kind of weigh how much capacity you have for risk, how much you can bring to the table and expand those odds. And I think that's just a self-education and comfort
Yeah.
finding mix.
Yeah, and so many other variables, like how much you have capital available to invest. If you have a lot,
Mm-hmm.
you might want to do a syndication because it's hard to deploy. If you have a little, a burr might be best because you can have less into the deal and time,
Yep.
right? Man, so great, Scott, dude. I appreciate you so much, man. Thank you so much for being on our show at our SOFA Summit here. You're the man. I got some great golden nuggets from you. I'm sure our listeners will as well. Please comment in these videos below, guys. Your thoughts on what Scott has to say, what strategies and tactics you're doing for your own investing. We are so grateful for everything we have. Thank you, Scott, so much.
Thank you, Sean.